This is Dr. Duru from Ahan Analytics with the Market Breath. I'm going to do something a little different this week with the Market Breath because so much happened, so many great, fascinating stories of individual stocks. I'm actually going to compress this video, get laser focused on the indices, ETFs, and whatnot that are key to the storylines. And there were several important storylines that all of us traders, long-term investors, day traders need to stay on top of here, because we had market rotation. We had deeply oversold conditions, not related to market breadth, but just deeply oversold conditions on individual narratives. We had a massive rebound, oversold rebound, and this is particularly focused on where people have been doing panic selling, cryptocurrency and software stocks. And then finally, we even had like this typical trade setup that has been almost easy money for the traders who like to play these kind of setups. And you'll see what I mean when I get there. And as a substitute for going into all the individual stocks that really caught my eye, I'll talk a little bit about them on my blog, drduru.com/122. I will pull up Swing Trade Bot, which is my favorite stock scanning tool. I know I haven't pulled it up in a long time, but it tells, again, a nice summary of what's going on with individual stocks and just how bullish, at least today's trading action was. All right, let's dive right in. Let's take a look. Percentage of stocks trading above the 50-day moving average, what I like to call AT50 for above the 50. Quick refresher. This is why I was bearish for so long. We had this double fade from the overbought threshold, the AT50 rules say to be bearish. And bearish was exactly the right call, but it was only the right call for a certain group of stocks. As I said in the intro, even as there was bearish trading action going on under the hood of the indices were relatively resilient until the last, I guess, day or two of selling. And there was market rotation going on in another sector of stocks that really held up the trading action. And I'm going to show those in a second. But I need to really dive in a little bit to this market breadth story. You could see that after the second failure, market breadth pretty much fell down in a straight line all the way until yesterday, which was February 5th, 2026. And now I can show you the reason why I have to back off my bearishness is because today, February 6th, the AT50 gapped higher, so it gapped up above the entire candle, filled the day's gap, and gained 10.7 percentage points to close at 59.7%. Now, market breadth is still in a danger zone, but I can't be so bearish now because this could be the beginning of a recovery. Even if the recovery is choppy, this could be the beginning of recovery to go back at least to the overbought threshold. So now I'm neutral on the market. Let's take a look at the percentage of stocks trading above their 200-day moving averages just to do a quick sanity check. And yep, it's still relatively in bullish territory. So long-term market breadth still looks good. This is AT200 and it closed at 62.3%. And let me pull back so you can see what I mean. It's still generally above in this area here, which is above the breakout from the last downtrend. So that's why I'm saying that the longer term picture still looks pretty good. Let's take a look now at the indices, and now you'll get a sense as to the kind of divergence that I'm talking about. So the S&P 500, remember, it set an all-time high right before the Fed gapped up to an all-time intraday high and then just started selling almost nonstop. It briefly paused when the month, February, opened up with a nice 0.5% gain, but then the selling resumed for the next 3 days. And it was pretty deep selling. And then today, and then there was the 50-day moving average breakdown. Now, a 50-day moving average breakdown is supposed to be bearish, but guess what? And hopefully those of you who've been paying attention know exactly what's coming. Instead of being a bearish sign to sell, this was a bullish sign to buy just based on the index's behavior the last 4 times, right? So, of course, the second time here, it was a little sloppy, but still, breaking down below the 50-day moving average or testing it or coming close was a signal to buy for short-term traders. And look at this, it's worked 1, 2, 3, 4, and amazingly for a 5th time. I thought after the 3rd time this pattern would fail, and yet this pattern continues to persist. It's absolutely amazing. So today, surge, 2.0%. In the S&P 500, it's back above its 50-day moving average. So it is essentially it's recovered, invalidated the bearish sign, and is back in relatively bullish territory. Even though, remember, short term, I'm now upgrading from bearish to neutral. Now, what's interesting about the S&P 500, the second reason why I have to go neutral is because the equal weight S&P 500 shows us that the bearish story never had a chance to last. Because this is the Invesco S&P 500 Equal Weight ETF. It's ticker symbol RSP, and basically it evens out the playing field. So no stock has a dominant influence, an oversized influence, on the index. Every one of the stocks in the S&P 500 in the RSP contributes equally. So Nvidia, Microsoft, Amazon, Tesla, all of the big cap tech stocks, they contribute to this index as much as the tinier stocks in the index. And look what happened. As the S&P 500 slid, as market breadth took a steep dive, RSP was pretty much fine. It just kind of churned in place. It gently tapped this 20-day moving average, this dotted line, and it resolved into a new all-time high today with a 1.9% gain, of course, thanks to the S&P 500's one big surge today. This is bullish. I mean, there's no other way around it. I can't be bearish seeing the equal weight perform and handle itself so well and resolve all of the volatility that we just saw to the upside. Now let's take a look at the NASDAQ, because of course a lot of the pain in the market this past week and maybe 2 weeks has been from tech stocks. Tech stocks are not out of the water. Now, if I were only in tech, I would be as bearish as I was coming into this week. Look at this. We now have a confirmed double top from the all-time high set earlier. This in October, and the NASDAQ failed neatly. I mean, almost picture perfect. Failed right at that all-time high. This is a classic textbook double top, okay? And that double top was confirmed by two closes lower than the 50-day moving average. Again, that red line. Let me zoom in here for you. And then we had a third down day, and that confirmed the bearish action even more. However, now if you're a short-term trader in particular, these are the things you have to be careful of. If you went into yesterday bearish, and then you saw this kind of action, a gap down well below the Bollinger Band, you have to start backing off of some of your trades, unless you're just an uber bear and you think the market is going to collapse, or you think the market's going to be in sell mode for months to come. This is a time to take some off the table, and that's what I did. Because at this point, the selling, the panic, whatever's going on is overextended. The Bollinger Band describes, in this case, the way I've set it up, expected volatility for 80% of the price range, right? So when it goes below this, we're talking about a 2 standard deviation move. Sometimes it's a 3 standard deviation move. And again, this is just related to statistics. So the higher the standard deviation move, the more of an outlier you have. And so this is essentially an outlier move in tech stocks and the NASDAQ as the representative. And we can't say for sure there's going to be a rebound, but if one does happen, it can be sharp. And that's exactly what happened. The NASDAQ rebounded 2.2%. But notice, as strong as this day was for the NASDAQ, it didn't even come close to retesting the 50-day moving average. So buyers in tech have a lot left to prove. And as we know, some of this is because of software stocks. And I'm going to get into software stocks in a second, but I need to talk about my favorite IWM, the ETF of small caps. There's also a story to be told here. Now, small caps were part of the drag on market breadth. You could see after hitting this all-time high, this was back in late January, the sellers took over. If you recall, if you saw my previous video, I took a chance on a calendar call spread. I got very lucky to be able to scrape some profit from there before this next 2 days of selling. And of course, since I have this trading strategy down now where I am rotating through call options around my core IWM position, guess what? This test on 50-day moving average, automatic for me to buy. Right now, the IWM has not been as consistent as say the S&P 500, but still, this kind of test and it's below the Bollinger Band tells me that the odds of a rebound are pretty high. So I went ahead, loaded up on some call options, and sure enough, IWM popped 3.6% today. Now I took profits, I think at around the 2% point because I thought the 20-day moving average was, going to hold as resistance. It did not. And because it did not, because IWM was able to pop higher and actually the high for the week, let me zoom in so you can see that, small caps are back into bullish territory as well, okay? This is another reason why I had to back off my bearish call and just go to neutral. Why am I not bullish? You just saw why I'm not bullish, because the NASDAQ is lagging and the NASDAQ and tech stocks are still very much in bearish territory. Okay, so hopefully that all made sense. Again, any questions, comments, always put them down below. Subscribe to the channel if you want more content like this. And of course, like and share so that the algorithm knows what's up and other people can find out about this, about what's going on in the stock market. And as always, if you trade and invest on anything you see here, remember this is for educational purposes, and keep your own time horizons and risk preferences in mind when you do that. Okay, let's go to the VIX. Now, the VIX is the volatility index. It shows, it's a proxy for market fear and complacency. This is another textbook move, right? Fear and panic just do not last. It's exhausting to be afraid and scared and running. At some point, sellers exhaust themselves. And that's exactly what happened here. The VIX surged. Look at this again, above the upper Bollinger Band. We know that once this starts happening, the exhaustion phase is coming, and the exhaustion phase came like a mug, as we used to say back when I was a kid. The volatility index plunged 18.4% today, but it did not, notice it did not get back below this key level that I'm keeping an eye on. What is this key level? This is where the volatility index was before last April's tariff drama, trauma, and noise, okay? This has become an interesting and fascinating, persistent, lasting pivot point ever since, that big surge burned off. Look at how it's been a pivot just these last 2 weeks, right? And if you're looking very closely within this pivot, and sorry I didn't draw the trend line here, but actually maybe I could just draw it in here for you really quickly. Notice that the VIX is still trending upwards, okay? So yes, it got overstretched several times in the last 2 weeks, and then the volatility faders stepped right in. People sell, they fade VIX or they sell put options and whatnot to take advantage of the premium that goes into options when volatility goes high, but they have not yet broken this uptrend. So this is another reason why, yes, I want to be bullish because of RSP and IWM and all of that, but the tech stocks are helping, I think, to keep volatility on this overall uptrend, okay? So keep that in mind. Let's keep an eye on the VIX. If the VIX manages to break this uptrend line, then it will truly be an open runway for the bulls to go. All right, hopefully you get that. Again, comments, questions, put them on down. All right, let's zoom in on some additional, I promise I wasn't going to go into a lot of individual stocks because there's just too much going on there. We're still in the middle of earnings week, but I do have to show some individual ETFs and indices. Gold. I talked about the gold trade in my blog. I wanted to give a quick update. I'm still bullish gold. Look at how well this 20-day moving average is still guiding gold generally higher. It's still uptrending. Remember, if you read the blog, I sold a February 400 put, and I used that to pay off some of the calendar call spread that I bought at the 500 level. So I think it was a February expiration and a April expiration for the calendar call spread. So I wanted to reduce the cost of that by selling the put. And I also explained how this may look risky, but because I don't mind buying gold somewhere below 400, I forgot the premium that I paid, I'm all good with doing this move. Now, with volatility plunging and gold holding firm, most of the premium on that put option I sold evaporated. So I went ahead, took the profits there, and now I'm just writing the calendar call spread. And of course, my risk is much lower. I also now have room again. So if gold has another sell off, particularly what I really want to see is a sell off all the way that touches the 50-day moving average, I want to be a buyer again. I want to add to my position and or sell another put option, which would probably be, maybe 380 or 365 level. And this is how well the 50-day moving average is held, right? Ever since this breakout to all-time highs, gold hasn't even tested that. So we do know, I do expect, particularly because gold went parabolic here, I do expect at some point with this exhaustion of buyers that happened in this parabolic move, that at some point gold will test its 50-day moving. It's just the physics of the market, and it's trending up. And unless buyers can keep up the pace, it's gonna have to run into the 50-day moving average. And remember, again, I keep saying this when I see parabolic moves don't last. You cannot chase parabolic moves and have good risk reward entries. And whenever that parabolic move ends, you don't know exactly when, the reversal tends to be sharp and painful and abrupt. And that's exactly what happened to gold here. After its parabolic move, the first break caused a 10.3% drop. And then the next day follow-on selling was another 4% drop. Silver, and that's ticker symbol SLV, had an even worse time of it. Now, ironically, I didn't really think that silver was as parabolic as gold because it didn't quite close above the upper Bollinger Band enough or stretch above it enough, but the buying has just been even more persistent than gold. And let's just do a reminder. I'm peeling back here. Silver, when it broke out, it was only trading at around 24, right? And essentially, it went up by 5x, 5x since, what is that? March of 2024. That's just a lot, right? This is almost 2 years of just relentless buying that now accelerated for most of 2020. So for all of 2026 until this massive drop, right? This massive drop was a 28.5% plunge. That is a major exhaustion. And this is damage to silver that's going to take a long time to repair, right? The buying just got too frenzied. And look how silver acted differently than gold. Yes, it rebounded off of this nice 50-day moving average. Let me zoom in here so you can see. Again, I got to love the technicals. Perfect bounce off the 50-day moving average. Relief rally, but it stopped cold at its 20-day moving average as resistance. And what happened after that stop, after that resistance held? Boom, silver fell another 15.8%. This move basically flattened out silver for the year. This move says that buyers just completely exhausted themselves in this relentless frenzied buying that happened. I mean, silver is even back to where, and I'm talking about ticker symbol SLV, is even back to where it was when the CME increased margin requirements and caused the first small sell-off. So while I'm overall bullish of silver, I think for me, it's just too volatile right now and too risky for me to find a comfortable entry point. And now that it plunged below the 50-day moving average, it's almost in bearish territory, again, for short term. Okay, hopefully that made sense. Again, questions, comments, put them down below. All right, I want to go to XLI. I did a quick short on this before, and hopefully you had a chance to check out my short when I did it. When I posted the short, I said this was a nick in my bearish thesis because we had, for the first time, some good fundamental data from the manufacturing sector. I won't reread it again. And XLI broke out to a new all-time high on this news. And look at this. The buying pretty much persisted. And on today's big surge day, XLI jumped 2.9% to a new all-time high. So this confirmed the bullishness overall for XLI. This is the State Street Industrial Select Sector SPDR ETF. Those of you who have been following closely and know me, guess what I'm going to say? Can't chase this. As much as I wish I was in XLI, I can't chase this move well above the upper Bollinger Band. And yes, that kind of buy would have worked just fine way back here on January 6th when it did something similar. And then it plunged back. That was the time to buy. So I don't chase things above the upper Bollinger Band unless I have some super strong reason. And it's very rare I have a super strong reason to do so. In this case, I'm not going to do it. But on the first decent pullback, sharp or whatever, I think I do want to start to get a piece for XLI. XLI is going to be one of those themes for the year. It did not make it on my shopping list for 2026, but I think I'm going to make an addendum for XLI and various components of XLI like Caterpillar and so on. All right, now let's go back, flip back to, so again, things like XLI make me want to be bullish, right? So I'm going to be going back and forth, bullish, bearish, all the time in the middle. I'm going to be neutral. Let's go back to what's making me bearish overall. Now, while I am still making the case that there is just panic, that what's going on in the software is just absolute extreme panic, this kind of persistent, relentless selling for weeks on end, for months on end, is very bearish overall. Today, IGV did rebound 3.5%. And notice, again, technicals are lovely. Guess where it rebounded from? It rebounded almost perfectly from the closing low of the April the April tariff trauma, drama, and noise. Now, I had on my shopping list to buy IGV at this point at 81. I did not, because I have started to accumulate enough individual software stocks that I don't feel really rushed to get into IGV. But I'm realizing, as I'm actually talking to you live here for the recording, I'm realizing that I do need to start to nibble on IGV and make this a core part of my software plays. The trouble of doing this is that IGV includes software stocks that I think will be hurt by the AI revolution, and some stocks of companies that will survive just fine. So my individual stocks that I have are the ones I think will do just fine. IGV would be more of a sector-wide play. Let me see whether, overall the sector is going to survive this, right? So stay tuned on that one. But just know that there are individual software stocks. I have what I think is almost enough of them. Almost everyone on my shopping list that I've talked about in previous videos and posts is now somewhere in my portfolios, whether it's a short-term trade or a long-term committed investment. So they're in there somewhere. So I just wanted to make that part clear. But why is this bearish? Because 50-day moving average is pointing down, 20-day moving average is pointing down sharply. Yes. It is so oversold. Look at how, again, remember how I said on the upside when buyers are just pounding the table and it keeps closing above the upper Bollinger Band? Same thing happens on the downside. I showed this earlier in a video how I did a trade on Wix.com, ticker symbol WIX. Same thing with IGV. At some point, sellers just get exhausted. And you can see here, let me make it clear for you. Let me change the scale. You can see how IGV extended way below the lower Bollinger Band. And actually, again, as I'm talking to you, I'm realizing that this actually would have been a good setup given IGV had closed below my 81 target. So, but again, I had so many other trades going on. But looking at this, I'm seeing that in terms of my trading rules, actually, I should have just gone ahead and bought it. Even at 81, I should have bought it and then bought more at 80 or 79. Anyway, there's no shoulda, woulda, couldas here. It just is what it is. So that's the bear side. And what was I saying is that, yes, it got so oversold, it's going to rebound. Dead cat bounces always happen in bear market moves. This is a bear market for software. It's already over 20% below its all-time high, but it's going to stay a bear market until it starts taking out key resistance levels like the 20-day moving average, like the last peak, like the 50-day moving average, and even better, above the 200-day moving average, which is the blue line. Okay, now let's look at how technicals tell you the story. Let's go to semiconductors, right? So semiconductors are pretty much at the center of a lot of what's going on with the AI trade. Check this out. Perfect picture, perfect test of the 50-day moving average support line. Actually, I'm underinvested in semiconductors, so this would have been a time for me to go ahead and buy at the 50-day moving average, but I just had my eye on so many things. I'm only taking a look at this on Friday where it's too late, of course, to go back. I can't go back in time and replay this. But if you were checking out semiconductors and keeping an eye on it this week, hopefully you put on your technical hat and just went ahead and bought in. And if I had bought in, I would have also just taken quick profits on today's 5.4% gain on SMH. So this is the bullish side of the story. Semiconductors as a whole survived a key technical test, confirmed 50-day moving average support. So semiconductors are on the bullish side of the ledger, whereas software is on the bearish side of the ledger. Industrials and manufacturing companies are on the bullish side of the ledger. Small caps are on the bullish side of the ledger, and tech stocks in general, thanks to software, of course, are on the bearish side. So hopefully, this, like I said earlier, we have these divergent narratives going on, and they're all going on at the same time, and there's some market rotation that's taking money away from the previously hot tech stocks and putting them into these other sectors that have been ignored for so long. All right, this review of the charts would not be complete without showing the other overhang of the market, which is cryptocurrency. I don't have time because I wanted to keep this shorter to talk about my own strategy for crypto. I've talked about it on my blog. But, crypto follows a lot of great technical moves. This is classic panic, just frenetic, throw everything out with the bathwater kind of selling. Look at this steep drop. I mean, on Thursday, Bitcoin dropped 14%. That's crazy, well below the lower Bollinger Band, right? So a bounce had to come. In fact, let me just show you more clearly just how bad this was. Look at that. It fell, and then on Friday at the lows, I think this is at midnight, sometime around, it hit a 16-month low. So when something hits a low that's this long in the making and well below the Bollinger Band, if the buyers show up, it's going to be sharp. And sure enough, Bitcoin popped back up 12%. Unfortunately, this is classic bear market action as well. This is just not normal to have big drops and then big gains. At some point, there's going to be a resolution. The bears or the bulls are going to wear each other out, and then emerging from the dust is going to be the people who carry the day. But I can't tell you from here whether there's going to be the bulls or the bears. And this is because Bitcoin has been bearish for quite some time. If we look back to these fake outs, this is essentially a double top that happened in August and October. And the other thing that makes me very concerned about Bitcoin is that all the fundamentals are supposed to be in place for Bitcoin. The regulatory tailwinds, the institutional investing, which ironically is part of the reason why this selling has been so vicious and so persistent. Again, don't have time to get into all that. And then we also just have volatility, concern about government debt, and everything else that, Bitcoin in particular is supposed to be a hedge against, and it's not working. It's completely broken. This is a broken asset until buyers prove that it's working again, right? So just to be clear, I'm definitely not one to sell or fade or short Bitcoin, just because, like I said, at any time, for any reason or for no reason at all, Bitcoin could go up 20% tomorrow. It can also go down 20% tomorrow for no reason at all. That's just the kind of asset it is. But I'm trying to stay with this because I know there's a hardcore set of people who are firmly behind this thing, and I want to at least have a piece of it and see just what happens over an extended period of time. Anyway, all that to say is that this has been also a sentiment overhang for the market, particularly for tech stocks. And you saw what how the NASDAQ has sagged. It's now correlated again with the sagging in crypto. And Bitcoin is just part of the story, right? There are other cryptos that have been even worse than Bitcoin. So all that to say, this is another bearish overhang. So the Bitcoin goes in the bearish side of the ledger. I think it's great for trading in this part, but again, it can move anytime, any amount, anywhere. And let me show you one example of how this overhang played out using ARK Blockchain and Fintech Innovation ETF, right? So I was short ARKF, sorry, this is ticker symbol ARKF, but I was short as a hedge to other positions that I had. So I can't, I'm not waving a victory flag or anything on this. It was just a hedge. And I hung in there as long as I could with my short, but then I just saw this just selling, just relentless. Again, I can't repeat this theme over enough. Selling, just relentless selling over and over and over again, well below the Bollinger Band, and boom, I actually covered on Wednesday because I thought that was enough, and it still fell another 5.7% the next day to a, what was this? This was a, yeah, it hadn't hit this price in since last April. And again, late April, I think. And we all know what happened in April, of course, and all that time frame. So I don't have to repeat that. All that to say is that this is well overextended. So I'm not surprised at all to see this rebound of 4.5%. I'm more surprised that it got this low so fast. But again, crypto was the overarching driver of this. So what to do now with ARK F? Well, again, I'm gonna have to write about this in the blog. I've written about how I'm bullish over the long term on Robinhood. Robinhood was a stock that was falling just along with ARK ARKF, and it has earnings coming up, so it is right there at the top of my shopping list. And I actually took a short-term trade on it. Actually, gosh, since I'm talking about it, I need to show the chart. I was trying to stay away from individual stocks. I couldn't help myself. Here's Robinhood, ticker symbol HOOD. You could see it followed pretty much the trajectory. It's been bearish for a while. It hasn't been the same since it last reported earnings, 10.8% drop. 50-day moving average resistance held. 20-day moving average going down, downtrend, broke down below the 200-day moving average. This is when I pointed out that Robinhood become bearish, and then it just pretty much fell out of bed straight down for the next 4 trading days. This is a classic warning and reminder of why these technical breakdowns are so important. Robinhood got so overextended on Thursday, 9.89% drop to a low from last summer. And then today it soared 13.9, essentially 14%. I went ahead and bought a small position here. I can't remember the exact price. I think it was maybe around 82.50, something like that. I can't quite remember. It's a high risk trade. I don't plan on holding those shares through earnings. And then after earnings, I'm going to reevaluate how I want to position myself. Because again, longer term, I'm very bullish on Robinhood, but the price action right now is very bearish for the stock. Okay, sorry I broke my promise. I went into an individual stock. Here is where I really wanted to talk about the individual stocks. This is the extent I want to go to. Swing Trade Bot is my favorite scanning software for individual stocks and indices and ETFs. And what I just wanted to point out is that when you look at Swing Trade Bot, things look extremely bullish. Okay, so here are all the signals for the different indices. If you read really closely, most of them are bullish. The one I really want to point out here is the 180 degree or 180 bullish setup. That's the one that keeps coming up over and over again across the indices, okay? I'll just show other bullish signs. Look at the new highs, way over dominated. These are new all-time highs, I think, versus new all-time lows. I mean, it's not even close, more than 10 times as many. Bullish versus bearish signals from Swing Trade Bot. I think this is like a double. Yeah, it's more than a double. Bullish signals over bearish signals. Advancers and decliners. Advancers 4607 versus just 1138 decliners. So all of the technicals extremely bullish today, extremely big rebound and jump. There are 2 particular scans I want to point out to you. If you do happen to have Swing Trade Bot, these are the ones I'm going to be using this weekend to identify some trades. And I don't want any stocks that have earnings coming up for these short-term trades, but I'm going to be scanning for the 180 bullish setup and what's called a morning star. And I actually don't see it on the indices. So I'll have to go to there really quickly. So let's just click on what is the 180 bullish setup? Well, there's the definition. I'm not going to read it to you. You can hit pause on the video to read it. And I'm going to scroll down to show there are 69 stocks 69 pages of stocks. And I think each page has about 20 stocks that meet that criteria. I had ETFs and stocks selected here. Let's narrow this down. Actually, it is 15 pages of about 20 stocks each page. So that's, about, 300 stocks? Too many to be trading, right? Too many to be looking through individually. So I'm going to have to do some additional filtering on those stocks just to get it to a manageable list. And I wanted to point out, let's go back to the chart and show you. Let me go to the other scan that I wanted that also came up handy. I thought I had this nice. Okay, let's go back to general market overview. I forgot to scroll all the way down to the other part I like to look at for swing trade bot, which is the unusually active signals for the day. And in there, we see 3 out of the 5 are bullish, and this one caught my eye, the Morning Star, because it had 48, extremely high, extremely unusually high, right? And the reason why this caught my eye is because a Morning Star is a typical sign of a bottom. And in my preparation here, I found one stock in here that everyone should know by now that met the criteria. Let's see. Oh, right. Find stocks, Morningstar. Oh, no, not the Morningstar. Oh, gosh, this got updated. Sorry about that. Let's just go. I'm going to cheat. And sorry, hopefully you're not getting dizzy with me scrolling around. Let's go to, I was trying to make this my big punchline. NVIDIA made the list. And you could see the 180 bullish setup. I thought it also hit the Morningstar, but the 180 bullish setup, NVIDIA is part of this huge group of stocks. So let me again remind you, there's a lot of them. Here's the definition again. And there is 300 stocks. Actually, now it's reduced to 8 pages. I guess I caught Swing Trade Bot in the middle of some updates. So sorry about that. Over the weekend, I'll come in here and find the final numbers. But anyway, the general theme stands. And let me show you why I'm using NVIDIA as an example. Is that I saw a lot of this kind of action where we had a lot of selling and then a gap up on this day, today, Friday, that essentially trapped the bears. So if you were overplaying your hand as a bear or as a seller, you got caught with this big move meaning a gap that gapped higher above the previous candle. So now all the bears, all the sellers are what's called trapped. And now if they're trying to get back into a position or they're trying to cover a short position, now they have to chase price higher, and that can actually accelerate or further strengthen the upward momentum as more people try to rush back in to the position. And you can see here that was golden for NVIDIA. It soared 7.9%. It's part of how the SMH, the ETF for semiconductors, was able to hold its 50-day moving average support so well. And now NVIDIA is back above its 50-day moving average. And I just realized this is the second individual stock I went into. But that one I had planned. I just forgot about it until just now. Now, despite this, now again, the other bullish thing about NVIDIA is that while it did not hit its 200-day moving average support quite exactly, it did come close enough. So it's bullish from that perspective. It's bullish because it's back above its 50-day moving average. But just remember that yes, NVIDIA is bullish, but overall, it's been going nowhere. In fact, it's been going nowhere since the middle of last summer. So until NVIDIA breaks out above the former all-time high, it is still under the haze, under the overhang of this double top from October. Okay. Now you can probably see, if you hung out with me till this long, you could see why I did not want to go into individual stocks and try to focus in on the key themes and stories as told by the indices and ETFs. But trust me, I had this long list of stocks that I was taking notes on all week long. It is too many to talk about. It's even too many for me to write about. But I'm going to do my best to put it in my blog and try to touch on these because they do explain some of my positioning and some of my trading. Anyway, please hit the subscribe button if you want to get more content like this. I'm going to have to do more individual shorts, the 30 to 60 second and to 2 to 3 minute long shorts, just to cover more of the individual stock plays that come across my desk. Thanks for hanging in there with me. Please be safe out there. There's a lot going on. Today's big move up did not end the volatility. That's in my opinion. I don't think it ended volatility. It did end most of the bearishness in the market for now, but that bearishness could show up in ways that I don't even want to try to anticipate right now. So for now, I'm neutral, and neutral just means that I prefer to stay patient and just watch and take the setups very carefully, whether on the short side or on the long side. All right, everyone, take care and see you the next time.